Before that, he was chief economist at the Housing Development Finance Corporation Bank. He's a regular commentator on television and has built up a wealth of knowledge in financial markets. So, Abhi, the floor is yours.
One of the things that I've identified over the last few sessions is one of the emerging themes of this conference is how little the G20 can actually do in different domains in terms of coordination. And I think, shadow banks is one of those cases where there's a strong argument, because the structure of shadow banks are so specific to each economy that, coordination beyond a point is difficult. And I think this is a popular argument. And the reason I show this, cartoon is not just to try and amuse you, but also to tell you that a lot of the stuff, the idea of shadow banking immediately sort of brings back memories of the 2008 crisis. And consequently, a lot of the literature on shadow banking happens to be US-centric, right? And what needs to be done in terms of, or development market centric, and what needs to be done in terms of rectifying the problems there. I would argue that this is not a very strong case, and the lessons of the US and indeed of the developed markets do have lessons for emerging markets. But I think first things first is we're talking about an agenda where coordination helps, and to the extent that coordination helps, I think there are a couple of things that we need to sort out. The basic thing that needs to be sorted out is a definition of shadow banking, right? I don't think as yet we have a widely accepted definition of shadow banking, because the Financial Stability Board uses a very nice but too general a definition of shadow banking, right? And puts a lot of things that actually shouldn't be considered a part of the shadow banking system into their definition of shadow banks, and consequently this gets reflected in their measurement of the shadow banking system. So one possible agenda for the G20 would be to arrive at a common definition, right? Although there are differences in structure, two IMF economists, Claessens and Ratnovsky, have offered a definition. And they say that, look, let's get rid of the FSP kind of approach, and let's define shadow banks as all financial activities that require a public or private backstop. There is, a copious discussion on this and why this should hold. I'm not going to go into it, but there is a more granular way of defining shadow banks. And I think one of the things that at least we can sort out in a forum like the G20 is to have a definition of shadow banks. Again, the last point here refers to what I was saying earlier. The literature happens to be very US heavy, but it does have applications, I think, in the Indian context, in the Chinese context, in the Japanese context, and so on. So, one of the worrying bits about shadow banking is, the size is crazily large. It's about 71 trillion US dollars for 2012, which is about 117% of global GDP. But if you look past the enormous geographical variations, you can also see that it's emerging largely as a problem of the developing economies, right? There is degrowth in places like Europe, and in places like China and so on, it's expanding. So I think from an emerging market perspective, or from an Indian perspective, that's something we need to sort of keep a close watch on. This is just a slide to tell you, how the shadow banking structure really figures, and in the larger sort of architecture of banking. But I'm not going to spend too much time on this. And let's just get to why I think the US experience is important for the Indian case. And if you just strip the very complex story of the U.S. financial crisis, and just look at the key players that led to the actual, transmission of the crisis to the financial markets, you would see that there are essentially three, and I think my previous speaker referred to it: the SPVs, which were, issuing securitized paper; the money market mutual funds, which were helping investment banks or the broker dealers to leverage; and the extensive use of repo mechanisms, again for people who wanted to invest in these very complex pieces of paper to borrow money. And then it all went bust because there are defaults on housing loans, house prices tanked, and so on, and everything just went belly up. But so the banking panic really, if you sort of reduce it to its bare fundamentals, really centered on the repo market, the markets for short-term paper, and it was related to the SPVs. My argument is that although we are nowhere close to where the US was in terms of size, the Indian market, in its sort of natural process of development and evolution, and I presume this is true of other emerging markets, is beginning to slowly will look like an American system, right? So the lessons from America, right, or what went wrong in America, are very critical in order to facilitate what I think is going to be an inevitable development towards the American sort of model of the financial system. And just to give you an example, I used to work for a bank until 5 days back, and one of the things that used to, every fortnight we had a strategy meeting, and one of the things that used to bother us was the increasing competition that we had from commercial paper for our loans, because companies are just going to the money market mutual funds, issuing commercial paper and picking up money. So this is just an example of how we are very far from the US magnitudes or the complexity, but we are moving towards an architecture which I think will remain the dominant architecture despite what happened in 2008. I think there is a huge need for securitization in the market, asset-backed securitization in areas like infrastructure. One of the things that causes this need is the fact that the Basel III norms are being introduced, and Mr. Gandhi and his colleagues are introducing norms that are much stricter than Basel, which will constrain banks' ability to lend. So you need to get your loans off your books and release capital. So securitization will have to be used. So that's another pillar of the American system. And you also need more active short-term funding sources. And we have a small intercorporate repo market, but I think that will have to develop going forward. The bottom line is that I have a problem with the use of the word shadow to describe this kind of banking outside the conventional banking parameters, because the word shadow immediately sort of suggests something sinister, something very murky about greedy bankers taking advantage of some regulatory loopholes. That's not the case. And I think if you see a lot of literature, a lot of it coming from the Tom's colleagues at the IMF actually, who argue that the development of shadow banking has been partly a response to a genuine economic need, and a lot of it needs to be encouraged. And I think in the Indian case, we recognize this fully. For instance, the role of our shadow banks, the NBFCs, in the second-hand truck finance market, right, I think has been sterling. They've played a huge role in developing this market, and we have absolutely no problem with it. But classifying that as a shadow bank, right, automatically makes you suspicious that these guys are up to something funny, and the loan-to-value ratios. I think we need to get over that, and I think possibly using a different word. Parabanking also has very negative connotations in this country, but something else other than shadow might perhaps help, and that could be an integral part of the G20 agenda, I would suggest, Barry. But in terms of the global regulatory response and where we are, essentially, I think there have been three sets of responses. One is to converge, right? Take the shadow banks and get them into the conventional banking system, and increase the remit of the banking regulator, so that the banking regulator can sort of regulate all these entities together. It has its problems, so we'll get to that. Then there's the sort of ring fencing argument that separates the core banking activities, right, particularly the retail banking activities where the public depositors are exposed, get that, ring fence that, make that sort of watertight, and let the other activities go on with relatively, light regulation. And this, the Vickers proposal, which is being implemented in the UK, or the Volcker rule in the US, is very much a sort of a part of this ring fencing or, divergence argument, if you like. The third thing which a lot of people suggest would be to have specialized entities for the supply of the kind of assets that shadow banks were providing. These are the narrowly funded banks or the narrow savings banks for the money market mutual funds. I mean, to cut a long story short, just have specialized institutions with strict regulatory controls issuing these things so that you don't have the kind of excesses that you saw in the US. Each of these have a problem. Ring fencing doesn't, protects the core banking system, but the systemic risk caused by the sheer size, the macro risk caused by the sheer size of the shadow banks, which might be more likely regulated, could have serious implications and so on. What has been the Indian response? And I will not spend too much time on the Indian response because we have the real expert with us, but I will just talk a little bit about what we are doing, and I think what we're doing is very sensible. And I'm going to sort of take a stance on a particular issue that has become, I think, unnecessarily controversial here. I think we have accepted, we've sort of accepted the middle ground, which is a very sort of Hindu way of looking at things, that look at convergence, look at divergence, and then settle for something in between. Everything goes, but everything goes in a good way, I think. So I think the latest report, which has been sort of implemented in terms of regulations, says that, look, we need shadow banks. I mean, they're doing a lot of good, right? Let's try and regulate them at sort of at par with banks, but let's not try and make them exact banks. Have regulatory norms similar to that of banks in terms of capital adequacy ratios, risk weights, and so on. One of the problems that we had, and this is just sort of, I'm deviating a little, that in the big crisis of 2008, we also had a relatively big crisis in our financial system, which revolved around the shadow banks, and that was largely a liquidity crisis. So there's a huge emphasis on ensuring that shadow banks have enough holdings of liquid assets at every point of time. And then there has been an attempt to identify systemically important entities, right? And although there are about 40,000 plus shadow banks in our system, we've identified roughly about 1,000 which are important from a systemic perspective, and we've decided to look closely at them. We also, I think someone compared the Indian shadow banking world to that of the Amazon ecosystem, in the sense that you have so many of these very strange entities floating around all over the place. But they can cause local distress. And in fact, we've had some very politically sensitive events recently, the Sharada scam, for instance, problems with Sahara. They are there. I think they need to be regulated more closely, as you've suggested in one of your recent speeches, but I think they are not yet systemically that important. Final, assertion, and I'm going to take a stand on a particular debate, which I think is a debate which is somewhat misplaced. The big debate in India is about who should regulate the shadow banks. Right? Traditionally, Mr. Gandhi has been the regulator, right? And he wants to continue to be the regulator, right? But we have a financial regulation code which says, a new financial regulation code, the FSLRC, which says, look, take the shadow banks out of the remit of at least the shadow banks that don't take public deposits, which are quite a few, take them out of the remit of the RBI and put them under a super regulator, the United Financial Authority. Right? One obvious reaction is, look at the UK example, they're breaking up the FSA, so why have a super regulator in this kind of context? But I think the issue is much deeper than this, and I will let Mr. Gandhi comment on this. But I think if you just look at how shadow banks, which are our NBFCs, our non-bank finance companies, incidentally, they hate being called non-bank finance companies. One NBFC chairman told me is calling them NBFCs was like calling a man a non-woman, which is, or a woman a non-man, or whatever it is. But maybe we should do something about that. But I think there are two things that we need to recognize. I think there is too much emphasis in the regulatory, and this sort of is an example of the peculiarity of our structure, is that we tend to put too much emphasis on public deposit taking, right, as a source of risk for direct public deposit taking, as a source of risk for NBFCs. So one of the ways that we sort of categorize NBFCs is, are they deposit taking or non-deposit taking? But if you look at public deposits as a source of funds, it's a minuscule amount. It's just about 1% of the NBFC's funds. So I don't think that's a big deal. So let's get that out of the way. I think what is, what is important is that there is a very close link between the NBFCs, the Indian shadow banks, and the banking system, because the NBFCs are very critically dependent on bank funds, right, both directly and through subscription to their bonds and debentures that they issue. And so it seems to me that a logical way to regulate them, right, is to have a common regulator, right, both for the NBFCs and the banks, instead of having different regulators for the banks and for the NBFCs. I think the banks and NBFCs are so closely intertwined that, in the way I think about things, that they should be regulated by the same person, right, who regulates the banks, because there is a very close link between the two. This fundamentally goes against what the FSLRC is suggesting, but and this is something what Governor Rajan is very stridently defending. So I am on Governor Rajan's side, and I think there is a strong case for banks and our shadow banks to be regulated by a common regulator. And I would stop there. Thank you.
Thanks, Abhi. Let me now turn to our final panellist, Rama Gandhi. He was appointed by the governor, appointed as the Deputy Governor of the Reserve Bank of India in April this year, and I understand, joined the bank more than 30 years ago. So, and I think, as we just heard, Rama is in charge of banking operations, also non-bank supervision, risk monitoring. So given those responsibilities, I think you're a valuable insight into the role of shadow banking in the economy, including financial inclusion for those that can't access the traditional banking sector. So, Rama.
Good afternoon, everybody. Thanks for the introduction, Chair. The type of entities which are called as shadow banking elsewhere are known in India as a non-banking finance company, as Mr. Barwa mentioned. Are they in fact shadow banks? In our opinion, no, because these institutions have been under the regulatory structure of the Reserve Bank of India right from 1963. That is 50 full years before the rest of the world is talking about regulating them. In the wake of the failure of several banks in the late 1950s and early 1960s in India, large number of ordinary depositors lost their money. This led to the formation of a Deposit Insurance and Deposit Insurance Corporation by the Reserve Bank of India to provide the necessary safety net for the bank depositors. The Reserve Bank did then note that the deposit taking activities were undertaken by non-banking companies as well. Though they were not systemically as important as the banks, the Reserve Bank initiated regulating them as they had the potential to cause pain to the depositors. Later, in 1996, in the wake of the failure of a big NBFC, the Reserve Bank tightened the regulatory structure over the NBFCs with rigorous registration requirements, enhanced reporting and supervision. Reserve Bank also decided that no more NBFC will be permitted to raise deposit from the public. Later, that's the reason why the deposit taking by the NBFCs have been coming down in all these years. Later, when the NBFCs sourced their funding heavily from the banking system in the early 2000s, thereby raising systemic risk concerns, we sense that it can cause financial instability. So, the Reserve Bank brought asset-side prudential regulations on the NBFCs. The NBFCs in India include not just the finance companies, but also a wider group of companies that are engaged in investment, insurance, chit fund, nidhi, merchant banking, stock broking, alternative investment, etc., as their principal businesses. NBFCs, being financial intermediaries, are playing a supplementary role to the banks. NBFCs, especially those catering to the urban and rural poor, namely NBFC MFIs and asset finance companies, have a complementary role in the financial inclusion agenda of the country. Further, some of the big NBFCs, like the infrastructure finance companies, are engaged in lending exclusively to the infrastructure sector, and some are into factoring business as well, thereby giving fillip to the growth and development of the respective sector of their operation. In short, NBFCs bring the much needed diversity in the financial sector. The total number of NBFCs as on 31st March 2014 are 12,029, of which deposit taking NBFCs are just 241, and non-deposit taking NBFCs with the asset size of more than 100 crores of rupees, they are 465, whom we call as NBFC NDSI. And the NBFCs whose assets are between 50 crores and 100 crores, that is a little lesser size than the NBFC NDSIs, they are just 314. So, the remaining ones, which are less than 50 crores asset, they are 11,009. As on March 31st, 2014, the average leverage ratio of the NBFC NDSI stood at 2.94. Return on assets stood at 2.3, return on equity at 9.22, etc. The asset liability composition is like this. Owned funds, they are 23% of the total liabilities. Debentures are 32%. Bank borrowing 21%. Deposits 1%. Borrowing from financial institution another 1%. Then other borrowings 12%, etc. On the asset side, loans and advances, they are 73%, investments are 16%, cash and bank balance at 3%, and other assets about 8%. The dangers and the regulatory challenges that they pose. The growing size and interconnectedness of the NBFCs in India also raise concerns on financial stability. Reserve Bank's endeavor in this context has been to streamline NBFC regulation, address the risks posed by them to financial stability, address depositors' and customers' interest, address regulatory arbitrage, and help the sector grow in a healthy and efficient manner. Some of the regulatory measures include identifying systemically important non-deposit taking NBFCs as those with the asset size of rupees 100 crore and above, as I mentioned, and bringing them under stricter prudential norms, both capital adequacy and other exposure norms, risk guidelines, etc. Issuing guidelines on fair practices code is another set of regulation that we have put on NBFCs. Then aligning the guidelines on restructuring and securitization with that of the banks, that is a kind of convergence, and permitting NBFC NDSI to issue perpetual debt instruments also as additional source of financing. Just as the shadow banks, that is NBFCs in India, are of a different genre, the dangers posed by them are also of a different genre. Consequently, the regulatory challenges that we face today are different, which are as follows. First, there are law-related changes. There are a number of companies that are registered as finance companies, but are not regulated by the Reserve Bank of India. There are unincorporated bodies who undertake financial activities and they remain unregulated. There are incorporated companies and unincorporated entities illegally accepting deposits. There are entities who camouflage deposits with some other names and thus illegally accepting deposits. The law as it stands today is inadequate to deal with these issues. In order to correct this and initiate action against such violations, we need to bring a suitable amendment to the statutory provisions. The Reserve Bank is working with the government for such improvements in the law. Secondly, as the entities, especially the unincorporated ones, can spring in any nook and corner of the country and can operate with impunity unnoticed, but endangering their customers' interest. We need arrangements and structured effort for effective monitoring and market intelligence gathering. The Reserve Bank is restructuring its organizational setup, especially in its regional offices, for gathering market intelligence. Thirdly, empowering law and gathering intelligence by themselves are not sufficient. Enforcement of the law is also a challenge. This is primarily because of the various agencies involved in regulating the non-banking financial institutions. Right from the central government, ministries like Finance and Corporate Affairs, agencies like CBI and FIUN, regulatory agencies like the Reserve Bank of India, SEBI, and the Registrar of Companies, and the state government agencies like the police and others, all have to share information and coordinate and cooperate to bring in an effective, timely, and unified enforcement of the law. The Reserve Bank's state level coordination committee are being strengthened, and a national level coordination committee is also being considered. Fourthly, the international requirement is that the shadow banks be brought under the tighter regulation. G20 has already expressed it as a mission to be achieved by 2015. In our case, bringing them under regulation is not the issue, as they already are. The challenges for us is how differently or how closely we should regulate the NBFCs. To summarize, the shadow banks in India, that is NBFCs, are of a different type. They have been under regulation for more than 50 years. They subserve the economy by playing a complementary and supplementary role to mainstream banks and also in furthering financial inclusion. Yet, they do pose dangers, we agree, but of different variety. It primarily relates to customer protection or consumer protection. It is a constant endeavor of the Reserve Bank to enable prudential growth of the sector, keeping in view the multiple objectives of the financial stability, consumer and depositor protection, and need for more players in the financial market, addressing regulatory arbitrage concerns, which are not while not forgetting the uniqueness